Hi. Oh, nice. Mines and works. Are you a mining engineer? I've never actually met one, but I hear a lot about you guys. I'm gonna read something out to you quickly. It's a guy who shared on LinkedIn and I reposted it about tax in South Africa. So it says it's showing how much tax gets paid out of each metro. So the chart covers only the 8 municipalities because they have the highest number of assessed taxpayers. There are a few smaller municipalities where average income is surprisingly high. The top five are Gamagara, okanye Gamagara, and Northern Cape, Ntabankulu, COJ, Stellenbosch, Phalaborwa. So Phalaborwa and Gamagara, Northern Cape and Northwest, I think that's where the mining towns are. Tell me if I'm wrong, because I know Katu has a lot of money. You can see that in the what's the name? Property prices. I'm not an equity analyst. I'm in fixed income, so I've got a brief understanding of the tax windfall, obviously, which is probably gonna be like a big theme in the upcoming budget on Wednesday. But yeah, I know that it's a surprise that in Northern Cape, that Kamakara, or Kamakara, I actually don't know, in the Northern Cape, that municipality, as well as Phalaborwa in Northwest, that they're showing up there. That those are definitely mining towns. Oh, and then if anyone's interested, so Cape Town has 975,000 taxpayers. The average taxable income is 370,000. Jozi has 970,000. The average taxable income is 480K. Tshwane has 750,000 taxpayers. Average taxable income 412,000. Ekurhuleni has about 690,000 taxpayers. Average taxable income is 353. Tekwini has 670,000 taxpayers. Average taxable income is about 312,000. Nelson Mandela Bay has about 203,000 taxpayers. Average taxable income is 313,000. Mangaung has 136,000, that's in Bloom, 136,000 taxpayers. Average taxable income is 324,000. And Buffalo City, Egombo, has about 123,000 taxpayers, and the average taxable income is 311,000. I shared it on LinkedIn, you guys can check it out, but I found it really interesting.
Okay, term structure theories. This module covers 5 different. Term structure theories, as the name suggests, theories are just that. They are hypotheses that this is what is going to explain the shape of the yield curve. So if you're looking at the yield curve and it is upward sloping, why is it upward sloping? Similarly, if you're looking at a yield curve when it is downward sloping, why is it downward sloping? Why is the yield curve changing? And so forth. If there's curvature in the yield curve, why is it curving? And what is the hump? And so forth. So there are 5 specific theories. Again, they are hypotheses. They are not something that necessarily are provable. So we are just learning the element. one is unbiased expectations theory, also called as pure expectation theory. Under the pure expectation theory, basically it tells you if it is upward sloping, then market participants are expecting short-term view. If it is upward sloping, then market theory basically under the pure theory, also called as pure expectation theory. Under the pure expectation theory, basically it tells you if it is upward sloping, then market participants are expecting short-term rates to rise in the future. So remember, upward sloping yield curve will only occur if the spot rate curve is upward sloping. And the spot rate is upward sloping, the forward rate upward sloping is above it. So what it tells you is the expected spot rate in the future, not the actual spot rate as observed today in the spot rate curve, but expected future spot rate, one period spot rate in the future. So after 3 years, we are expecting the 1 year rate to be so and so, and that is equal to the forward rate corresponding to that same time period. So today's spot rate, we can derive the forward rate, and what we are saying is if the forward curve is above, meaning the spot rate curve is upward sloping, then market is expecting that future rates are going to be higher. And why am I saying it? The keyword expecting, the expectations, and that basically the theory is used that expected future spot rate are captured by currently traded forward rates. So the current forward rates are unbiased. Unbiased means market does not over or underestimate. Market can be wrong, but it is the average of the expectation will be the same as the forward rate. It is not consistently over or underestimating future spot rate. So the long-term interest rate therefore will equal the mean of expected future spot short-term rates. And again, because I can't actually capture or I can't objectively collect the data on market's expectation about future rates, I cannot prove or disprove this theory. So it is just a theory. It says simply that there is no risk premium. Rates can be high, can be low, can be any shape. It simply reflects the market's expectation, and market expectation are simply are priced in or captured by the currently observed forward curve. So key takeaway: no risk premium, and forward rate is equal to expected future spot rate. That is the unbiased expectation theory. Unbiased means there is no bias. The market does not overestimate or underestimate. It can make an error, but the errors are random, and the expected value of the error is 0. All right. The next one is the local expectation theory. Local expectation theory basically says that supposing, remember, we talked about if you buy a longer term security or a short term security, 1 year security or 3 year security, and if your forward rates exactly correspond to the actual spot rates that occur, if the spot rates actually correspond to currently captured forward curve, then your return will be the same. Well, that is what this local expectation theory says, that the forward curve only will hold true for short end of the maturity spectrum. It doesn't specify what short term is. So only short term, the forward rate is equal to expected future spot rate. Longer term, we have seen that there is risk premium. So people can earn a higher rate by holding longer maturity bonds if their holding period is longer term. Now, again, as I said, the term is not defined as 30 days, 1 year, and so forth. So we can't actually test it, but obviously, if I take randomly some cutoff point as the term, then I can do some data mining and prove this theory, but nobody will listen to me. All right, the third one is the liquidity preference theory. This is very old. Originally, John Maynard Keynes came up with this theory, and the label liquidity is actually kind of a misnomer taken in the context of current market, taken in the context of what you guys are learning. So instead of liquidity preference theory, I would call it maturity to kind of remove the cognitive dissonance when you read this. But again, the true name is still liquidity preference theory. I can't go back and change K's word. It's about 100 years old. So under the liquidity preference theory, keep in mind that at that time, the liquidity in the debt market was non-existent, or there were no secondary market or no well-developed secondary markets for debt securities. So what ends up happening is if I'm buying a 5-year bond, I'm stuck with that bond for 5 years. So under Keynes' hypothesis logic, people would rather not lock up their money for a longer period of time. I would rather only invest for 30 days or 1 year or 60 days. But to give me incentive to lock in for 5 years, I will have to do a higher risk premium. So it basically tells you that premium is positively related to maturity. As the risk premium, as the maturity increases, the liquidity risk premium increases. Again, liquidity risk that we know now is different than liquidity risk defined by Keynes. It is the risk of locking in your money without getting your money back. That's what Keynes is referring to. So it still relies on the pure expectation theory. So what I'm going to do is put yield and maturity on y and x-axis respectively, and I'm going to put in currently observed spot curve, and I'm just making up a random shape. Okay, and so for short term there is no liquidity risk premium, but as I go longer and longer out, I am getting a higher and higher rate, and so you see that the liquidity premium increases with maturity. So you get even steeper upward sloping yield curve in the market. But what if the spot curve was downward sloping? Well, liquidity risk premium would be less steep downward sloping. So in other words, the liquidity risk premium theory can explain any shape. It just has to take the word of the economists when they say, well, the true expectations are even steeper. Well, again, I can't see the expectation. I can't capture that data objectively. So I have no ways to refute it, no ways to test it. All right. So another key takeaway is forward rates are biased, and it is biased upwards. Remember, the starting point is the pure expectation theory, and then you add a risk premium to it, and then you get the resulting spot curve. So forward rates are biased estimates of and positively biased, and that bias is also not static; it increases with maturity. The next hypothesis or theory is that markets are segmented. So think of it as 3 segments, just scenario hypothesis. I mean, it's a simplistic scenario. So one segment comprises securities which are short-term, whatever you define short-term as. The second segment is comprised of intermediate-term securities, and then the last segment is comprised of long-term securities. So 3 different segments. Now imagine that these 3 segments are firewall. So there is a market for short-term security, there is a market for intermediate securities, and there is a market for long-term securities. Those are in the short-term market can't reach or hear or get information from the other markets. They are in separate parts of the world. So what happens in each of these segments is the yield is determined simply by demand and supply. So there are buyers of short-term securities and issuers of short-term securities. The demand and supply at which point matches, that will determine the price there being the yield. So so yield at each maturity, now if you divide it into even more granular segments, you get each maturity, and it is determined independently of other maturities. And yes, there is some credence to this theory because there are traditionally suitability aspects. So banks traditionally would prefer a shorter spectrum. Life insurance companies, pension funds, their liabilities are long duration. They may prefer longer maturity securities. Similarly, there are businesses that want to only borrow at for a short period of time because maybe they're borrowing for seasonality in their business. Some businesses want to build a brand new factory. They want long-term borrowing. So suppliers and investors, suppliers of capital and issuers of capital have their own preference, and they decide to go into which market based on that preference. So the markets are segmented. That is the hypothesis, that is the theory. The next theory builds on the prior one. The next theory basically said that yes, markets have segments, but those segments are not firewall. Those segments are observable by everybody in the market. So yeah, I may prefer to be a short-term issuer, but I can be bribed to issue for a longer term. How? By being able to issue at a lower rate as an issuer. Correspondingly, if I'm a buyer, if I'm an investor, I may be bribed by getting a higher rate into another segment. So it starts out with these segments, but the segments are not firewall, and investors willing to leave the preferred maturity to obtain a higher return, meaning pay a lower price. So there is a bribe, if sufficient bribe. There is a bribe available always, but is that sufficient to induce me to switch my market? switch my segment. So it can be used to explain almost any yield curve shape because demand and supply intersection occurs at different points in different markets or different segments. All right. Many fixed, quick example from the curriculum, many fixed income portfolio managers are limited or prohibited from high yield bond investment. When a bond is downgraded from investment to high yield rating, it is often referred to as a fallen angel. Because of the restriction, all of a sudden, what happens? Those banks that are, or those portfolio managers, fixed income portfolio managers that have or position in those bonds, sell those fallen angels. And so this coordinated selling action often results in lower prices and attractive yields for the fallen angels. And this is actually observed in practice in the market. Which of the following reasons best explains the fallen angel theory or hypothesis? Well, that is best explained by the segmented market theory. So even though those same bonds are now offering, because of the chain downgrade, are offering a higher yield, investors are not jumping in sufficient quantities. So it may be reflective of segmented markets that the buyers are prohibited from buying those quote unquote bonds. The next example is term structure theory, in which investors can be induced, right away. I should be looking for preferred habitat theory.
Yeah.
So that is choice A, preferred habitat theory, pretty straightforward. Unbiased expectation theory assumes that investors are
risk neutral.
Choice A, risk averse, risk neutral, or risk seeking. Unbiased expectation, because the forward rates are unbiased, or expected future spot rates are unbiased, that implicitly assumes there is no risk averseness among investors. So there is no inherent risk seekers, or no inherent risk averseness amongst investors for longer term in favor of short term. So they are risk neutral. There is no risk premium that they are demanding for investing in specific maturities. So that is pure expectation or unbiased expectations theory. Okay, next example, market evidence shows that forward rates are unbiased predictors of future spot rate, or upwardly biased or downwardly biased.
Upwardly biased.
Biased but upward, biased but downward. Those are my three choices. Now, the market evidence indicates existence of liquidity premium. Remember here, liquidity preference theory uses liquidity.
Sorry, my girlfriend is messaging.
In a slightly different manner. So the liquidity premium, as defined by Keynes, is evidenced by the market. So we see an upwardly biased predictor of future spot rate. So there is evidence of the existence of liquidity premium in the market. Lastly, market evidence also shows that short-term holding period return on short maturity bond is most often what? Less than those on long maturity bonds?
Yes.
About equal or greater. Remember, under the local expectations theory,
it's supposed to be the same, but it's not.
the evidence in the market suggests that that is not true. That even for a relatively short period of time, there is a risk premium, and therefore investors investing short maturity bonds earn less than investors issuing. Purchasing longer maturity bonds. So there is a risk premium even at short end of the spectrum, short holding periods. So refuting local expectations theory. So that is it for the module on spread measures. Keep up the good work.
I like it when he says keep up the good work. It makes me feel good. Okay, I've got one question. Which of the following statements regarding the traditional theories of the term structure of interest rate is most accurate? A. The segmented market theory proposes that market participants have strong preference for specific maturities. B. The liquidity preference theory hypothesizes that the yield curve must always be upward sloping. C. The preferred habitat theory states that yields at different maturities are determined independently of each other. C is not true. B. The liquidity preference theory hypothesizes that the yield curve must always be upward sloping. A. The segmented market theory proposes that market participants have strong preferences for specific maturities. Yes. I think B, it doesn't say that the yield curve must always be upward sloping. It can be downward sloping, the yield curve, but segmented market theory does say that yields are determined by liquidity premiums, or not determined by liquidity premiums and expected spot rates, but rather by preferences of issuers and lenders. A. Yay, I got it. Okay, so what's left? Oh, guys, fixed income is flipping hard. Fixed income. After this, it's either I do derivatives or I do economics. But I want to finish this weekend. Or not this weekend, this week, sorry, because Saturday I want to go out next week. I'm on 17% now. Okay, so there's yield curve risks and economic factors, then there's a quiz, then there's a question bank. Ugh. Okay, I need to go to gym because I actually went to the shops. I rode to the shops, but I didn't do gym. Yeah, let me see how big this is.
All right, friends, welcome back. And to end this reading, we have the last module, which is the...
Wait. There isn't a activity for this one. I thought there was a study. Yeah, notes before the master class. Okay, I think I'm gonna go to gym because they close early on Sundays, and then when I come back, I'm gonna do yield curve risks and economic factors. So the Schweizer notes, the master class, and then after that it's reading 24, which is arbitrage free valuation framework. I can already see that's gonna show me flames, and then There's valuation and analysis of bonds, which is where your duration comes in, your convertible bonds. If I can get to even starting reading 25, I would be good today. But I think I'm being, yeah, because after I go to gym and I come back and I shower, I'm going to be so tired. But I'm just going to make another coffee. But I think it's looking good. I feel positive. I think once I get to 30%, if I can get to 30% before end of Feb, then I've got March. If I can do, actually, let me see if I can do 30% now, then that'll inform what I can do by March. But I want to be at like 70% of the content, because I think a big part of the content is the exams. So, or the exam and the quizzes, which are important. But if I can get through the content, like I said, I've only done 2. I've done quants and I've done ethics. I'm busy with fixed income. There's derivatives, alternative investments, portfolio management, corporate issuers, financial statement analysis, economics, equity valuation, and final review. I know financial statements analysis is gonna fucking kill me. So if I can get fixed income and derivatives, maybe that can be 40%. I'm spiraling. Let me go to gym. Writing 20th May. Okay, I'll see you guys. I'm aiming to be back before 3. And yeah, you guys won't be able to smell me, but I won't shower, because if I shower, I'm gonna feel sleepy. See you soon.